When it comes to managing your finances, understanding the difference between secured and unsecured debt is essential. These two types of loans have distinct characteristics that impact your borrowing options, interest rates, and the risks involved. Secured debt requires collateral, like a home or car, which the lender can claim if you default. Unsecured debt, on the other hand, doesn't require collateral but typically comes with higher interest rates due to the increased risk for lenders. We'll break down these key differences and help you make more informed financial decisions. Today, we will talk about understanding secured versus unsecured debt. So before we start, make sure to hit the like button and subscribe to my channel. Secured debt, the basics. Secured debt is a type of loan that is backed by collateral, which acts as a form of security for the lender. Collateral refers to an asset that the borrower pledges to the lender as a guarantee that the debt will be repaid. If the borrower fails to repay the debt, the lender has the right to seize the collateral to recoup their losses. Common examples of secured debt include mortgages and auto loans. In these cases, the house or car serves as the collateral for the loan. The primary characteristic of secured debt is its lower risk for lenders, as they have the option to reclaim the collateral if the borrower defaults. Because of this reduced risk, lenders often offer more favorable terms, such as lower interest rates and larger loan amounts, for secured debt compared to unsecured debt. Advantages of secured debt: lower interest rates. Because the debt is backed by collateral, lenders are more willing to offer lower interest rates, which can save borrowers money in the long term. Higher loan amounts. Secured loans can allow for larger borrowing amounts, since the lender has an asset to claim in case of default. Better credit terms. Borrowers with poor credit histories may still qualify for secured loans because the lender's risk is reduced by the presence of collateral. Predictability. Monthly payments and terms are often more predictable, which helps borrowers budget effectively. Disadvantages of secured debt. Risk of losing collateral. If the borrower fails to make payments, they risk losing their home, car, or other assets. Complexity in default. The foreclosure process for secured debt, like mortgages, can be lengthy and complicated, leading to significant emotional and financial strain for borrowers. Over-leveraging risk. Borrowers may be tempted to take out larger loans than they can afford, especially if the interest rates are lower, leading to the risk of over-indebtedness. Unsecured debt, the basics. Unsecured debt, as the name suggests, is not backed by any collateral. Instead, it is based solely on the borrower's creditworthiness and ability to repay the loan. Examples of unsecured debt include credit card debt, personal loans, medical bills, and student loans. Since there is no collateral to back the loan, unsecured debt is considered riskier for lenders. Advantages of unsecured debt. No risk of losing property. Since unsecured debt is not backed by collateral, borrowers don't risk losing their home or car if they default, though creditors can still take legal action. Flexibility. Unsecured loans tend to have fewer restrictions and can be used for a variety of purposes, such as consolidating debt, paying medical expenses, or financing personal projects. Quicker access. Many unsecured loans, such as personal loans and credit cards, can be accessed quickly, sometimes within a few days or even instantly for smaller amounts. Disadvantages of unsecured debt. Higher interest rates. Unsecured debt typically comes with higher interest rates, as lenders have no collateral to recover their losses in case of default. Stricter credit requirements. To qualify for unsecured debt, lenders may require a strong credit history, meaning that borrowers with poor credit may have a harder time accessing these loans or may be charged exorbitantly high interest rates. Potential for aggressive collection efforts. In the case of default, unsecured debt collectors may use legal means such as lawsuits, wage garnishment, or bank account levies to recover funds. Smaller loan amounts. The lack of collateral often means that unsecured debt is available in smaller amounts compared to secured debt, making it difficult for borrowers to secure large loans without a strong financial standing. Key differences between secured and unsecured debt. Collateral requirement. The most obvious difference is that secured debt requires collateral, while unsecured debt does not. Risk level. Secured debt is less risky for lenders because of the collateral, while unsecured debt carries a higher risk for lenders, resulting in higher interest rates and stricter terms for borrowers. Interest rates. Secured loans generally have lower interest rates, while unsecured loans tend to carry higher rates due to the lack of collateral. Loan amounts. Secured loans tend to offer higher borrowing amounts, while unsecured loans typically offer smaller loan amounts. How to decide between secured and unsecured debt. Deciding whether to take on secured or unsecured debt depends on several factors, including your financial goals, risk tolerance, and current financial situation. For those who have the assets to back a loan and want to secure a larger borrowing amount at a lower interest rate, a secured loan may be the better option. On the other hand, if you prefer the flexibility of borrowing without risking property, an unsecured loan may suit your needs, even if it comes with a higher cost. When making a decision, consider the following questions. What's my purpose for borrowing? Secured loans are typically used for large purchases, while unsecured loans are more flexible and can be used for a variety of purposes. What's my risk tolerance? Are you comfortable with the idea of putting your assets at risk? If not, unsecured debt might be a better option. Both secured and unsecured debt play critical roles in personal and business finance, each with its advantages and disadvantages. Understanding the key differences between these two types of loans, as well as the benefits and risks associated with each, is essential to making sound financial decisions. Whether you're considering purchasing a home with a mortgage, secured, or financing a personal project with a credit card, unsecured, being informed about the type of debt you're taking on can help you manage it wisely, avoid financial pitfalls, and preserve your financial stability in the long term. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.